Hey, thanks for tuning in. In this video, we're going to discuss reversal candlesticks. As you can see, I've removed, all of the different indicators from the chart, no volume, nothing. All of that, can add more evidence to the puzzle. But for this video, we're just going to look at the candles and try to give you just a little bit more insight into how I look at them, how I read them. And yeah, we'll start off by identifying the 5 different reversal candlesticks that I see. We've got an outside candle, an engulfing candle, a gap, large wicks, and dojis. The outside candle is when the open and close is greater than the candle before it. And an engulfing candle is where you open near the high, close near the low, open near the low, close near the high. These, bull flag, bear flag poles that you see all over the, over the place. People talk about it like that. They reference it as a flag pole. The gaps are pretty obvious, right? Anytime, maybe it's not so obvious. Like these are pretty obvious gaps, right? The high here and the low here are different. But this gap here is a little bit less obvious, the April 21 into April 22, where, the close was down here at 204.78 and the open was up here at 209.14. So there's technically a gap there at 204.78. So that gap was a reversal. The big wicks that you start to see on these charts, especially on the longer time frames like the weekly and monthly charts, when you see large wicks associated with lots of volume, you have to be very cautious. And then the last one again here is the doji, right? The open and the close are about the same, and they don't have to be a perfect doji, right? This is a doji here from March 9. This is a doji. We got a doji here on the 24th, a doji here, just as the same as the 27th, the 15th, all the way back here. So it's just indecision. It really just shows you that the market was generally in balance that day and it just didn't go anywhere. And there's a lot of days where that happens. I mean, even back in 2019, you had a period of, December to January where the market just went up on a very low range. I mean, you're talking about $1 range on the Qs, and you just don't see that anymore. The ranges are much wider, much more active, and even here during this large correction, you could see the range. I was showing you just how emotional the traders were, right, and how expansive price was. So trying to keep with the context of reversal candlesticks, we want to talk about follow through. It's very, very important. One candle does not make a trend. And just because you have a doji here, right, a doji here, you had one candle close up here, then reverse. So you didn't really have any follow through. Same thing here. Outside candle, bearish reversal. Then you got the doji the next day, and you just started marching higher. So that really wasn't your reversal. Even though you got the gap down, right? You got the 1-day continuation. You didn't get anything else. And now that we're looking at this in hindsight, you could say, well, yeah, of course. I mean, that stopped price from going higher for 1 day, but she just put in a higher low and then marched for higher highs, right? And that's ultimately what you have to look at in a lot of these charts is are they putting in series of higher lows and higher highs or lower lows and lower highs? And when does that change? Right, and when that changes, take note. That's a change in character, and you have to understand that the market is not doing what it was doing. And once you get a confirmed, reversal, what you're looking for is 4 to 9 sessions of continuation, and try to then associate that with an Elliott wave pattern that can be swing traded. And that's kind of the core concept of a lot of my trading is using Elliott wave structure, using the moving averages. And these candlesticks to try to take trades as close to risk as possible. So yeah, let's take a look here at this more complicated time frame, right? The correction when you don't really know what's going on. So up here you've got the very first reversal. This is a bearish reversal candle. And we, from that day just accelerated lower, and like, here's another gap, here was a gap down, and just you continue another gap, right? Acceleration. So the bulls were trying to hold this series of higher lows. It failed when this low was lost. The bulls tried to reverse here with a little bit of doji, too much selling the next day, another bearish reversal. Bulls try to reverse again, another gap and go day, and finally an engulfing candle, right? So this is candle 1, 2, 3, 4, 5, 6, 7 candles from the top. You then had some little retrace. 1, 2, 3, 4, 5, 6, 7. So depending on how you want to count this, you could say we only had 3 days of retrace. The high was put in, and then you started the next leg lower. So just 1, 2, 3. You don't really get much in a serious zigzag pattern here. But the point here is you can look at these candlesticks and say, okay, the bulls are in charge on February 28th. They went up. They opened up here at 208.88 after closing at 206, so they gapped higher. And it didn't really make it easy for the bulls. And then on day 3, right, you have a bearish engulfing candle. Day 4, they're right back at the high, and day 5, they're below. So I'd say as soon as you lost this high here, this higher low pattern here, that was over. So you could say, all right, well, this was really the reversal candle here, so you did get 4 days, right? 1, 2, 3, 4, 5. But you could also argue that you got the bearish engulfing candle here. This is when the high came in, and that was the end of it. So it doesn't really matter how you count it. It's not so important. The concept really is, when you get a reversal candle, you're going to wait 4 to 9 days before looking for another reversal candle where price will just reverse again. And what you ultimately get over and over in the market is a lot of this. Just a bunch of little ABCs, up and down, up and down. And you have to kind of get the rhythm of that. And the reversal candlesticks are what start and end every one of these little ABCs, right? You'll find one up here, and you'll find one down here. I mean, that's true even in the market. In hindsight, it's very easy to point out, where the ABC is, right? Much harder to do in real time, but you can see, look, you've got your engulfing candle, you've got your reversal candle here, another engulfing candle here. So that signaled the B was in, the A was in, and we took our doji at the C. A gap signaled the start of this new impulse, right? And now you start to look for what Elliott wave pattern is going to come out of here. Something like that, for example. Again, all of these key pivots in these waves are going to be one of these reversal candles. So, the goal of you as a trader should be to identify these reversal candles and then associate them with some type of structure. And again, the rule here of 4-9 sessions, none of this is set in stone. This is just, on average, this is what I see. Sometimes it's 15 sessions before you get a reversal. But yeah, that's about all I have. I hope you liked this video. If you do, hit the like button, subscribe. Check us out on Twitter, MarketWizard87, and I'll see you in the next video.